I would like to focus a little bit on the examples, right? I think, a lot of people enjoy when, fund managers, portfolio managers, examples of the stocks that they have had to hold. I mean, they have had a success by holding, or, or situations where, you might have seen that, my conviction is not working out and I will have to exit this particular stock, right? So in the next part of the session, I would like to know about, instances where you have had to, make that decision to exit. And if you can add an example on, which is a high conviction stock that you held on to and which has been really, enjoyable for you.
I think I'll answer this by first setting the context, and I'll give you examples on both the business that's this inception of the fund and we continue to own. Why? Right. And second, businesses that we've exited, though the narrative was extremely bullish, and why. Right. So, like I said, for us, an exit is an equally, if not more important process as a fund manager than just security selection, because we are active risk managers. I don't come from the school of thought that you can buy, hold, and forget great businesses and compound capital. It doesn't work in my mind because we are risk managers at the very outset, right? So why do we exit businesses? Obviously, because business cycles can change and market cycles can change, like you highlighted, Ashwin and Kunal highlighted, right? And second is we are investing in people, and people change, right? When people change, capital allocation process changes. For example, Kunal has a certain style, Ashwin has a certain style, and if they move, their style changes. As a result of which, someone taking over Ashwin's shoes, I can't believe that he will run Ashwin's style because that's unique to Ashwin or that's unique to Kunal, right? So for us, when managements change, we care, right? So for example, to talk about a business that we have owned since 2017 and we continue to add. So this is a space called CDMO or CRMO, which is in the pharma business. It's a company called Syngene. And it has its legacy for almost 25 years in India. And having worked in Hong Kong and seeing China very closely, I had invested in what I would call a 10 times larger mothership of Syngene back in the early 2010s called Wuxi Pharmaceuticals, right? So coming back to India, having worked closely on Syngene, I think gave me a lot of context from my prior career. So analysts hated Syngene. Not now, since 2017. Pretty much most of the analysts, rest of India had a sell rating for what it's worth, right? Why? Because PE was expensive. The PAT growth or EPS growth was muted at 11-12%. So you'll have to think back, not today, but think back in 2017. If I am buying a business at a PE multiple of 48, and you know where Nifty was in terms of a multiple 5 years back, Sonam, right? We're not talking today. So people obviously question. And the questions increase when the share price doesn't move over 2 years, right? Because your performance is what guides how you think you actually matter from a business perspective. Why did we invest, right? At a fundamental level, the cash flow growth was compounding at 24%. And what was the management doing with the cash flows? It was reinvesting it into fixed assets. So today, if I look at Syngene's market cap of around north of $3.5 billion, right? In the last 4 years, roughly around 10% of this market cap has been reinvested in capex. So as you can imagine, earnings are going to be depressed. Why? Because all of this capex is still not yet gone live. In pre-2016, the fixed asset turns of this business was roughly around 2.8. And in 2018-19, it was 1.2, right? Because capex is only getting deployed. And for the first time, the capex is going to go live over the next 2-3 quarters. So the conviction happened because although the earnings was depressed, the cash flow was robust and it was getting redeployed into fixed assets, which is going live now, right? So the demand cycle is still robust. Cash flow growth is strong. And we still believe that this is still on its early stages in terms of what we anticipate over the next 3 to 4 years. So that's how the conviction formed. And we continue to scale. It's done reasonably well for us from an IRR perspective. If you look back, let's say 2.5 years, the narrative always was insurance is underpenetrated. India is great for insurance, and you need to be owning the market leaders. The narrative is clear, right? Nothing has changed in India over the last 2.5 years. And I think around COVID is when we significantly increased our stake in insurers. Two companies, HDFC Life, ICICI Lombard, market leaders in both life and general as far as we were concerned, and gaining market share. Now, three big trends that have happened, or three big levers for us to keep trimming, and we have our lowest exposure in insurance since inception today. Right? First is the market share growth, the market growth of APEs, which is called adjusted premiums, in terms of how you capture the industry growth, is roughly around 6% on a 2-year CAGR basis. Why do I say 2-year? Because 1 year is on a low base. So generally, I prefer to use 2-year because it will give you a more realistic sense of business growth, right? And on top of that, some of these businesses are actually losing market share. Not HDFC Life, but ICICI Lombard certainly is. Claims have gone up significantly because of what we've seen in the last 1 year. Along with that, interest rates rising, as a result of which your mark-to-market book will underperform short term. So from almost, I would say, 8-9 months back, we've trimmed our exposure significantly from a risk management perspective, right? So the narrative is still strong. The data, certain things have changed. And for us, we find better opportunities. So we have exited these businesses. Our exposure is at its lowest. And from our perspective, the narrative needs to match with the data. If not, we have an opportunity cost. And that's how we think about an exit.
Right. Thanks, Naveen. Thanks. It was a really insightful answer.